Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your host for the show, The Mortgage Voice, and the telephone number is 888-713-2929. If you'd like to give us a call, love to hear from you. We talk a lot about what happens in the mortgage market and why it happens. A lot of things going on here in January 2019. One of the things that I think you got to be aware of is that although the interest rates have paused and then they went down and now they're kind of back up, 4.5% 30-year fixed. For example, what you're going to see this year is a fluctuation in a lot of what goes on in the mortgage market. And why is that? A lot of the things have to do with what's going on in the government, the regulation, whether it's shut down, whether it's not shut down. And we're coming up to that again in mid-February, as everybody knows. And if you're out there right now and you've got a house that you want to purchase and you're in contract, it's very important that you get those requests for the tax returns to the IRS as soon as possible, because if they go out again and you need that tax return in order to get your loan, in order to close on your property, yeah, it's a real problem. So one of the things that we're talking about today's show is going to be what is happening in the market out there. What are you doing to try to solve problems that you can't control? I know that's kind of an oxymoron, right? I mean, if you're trying to be something you're not and at the same time have to, okay, so what do? You're a real estate agent out there, or you have a property in escrow and you're a buyer, or you're a seller who needs to get a closing because you're looking to close that so that you can go on and buy something else. You know, there's a lot of reason to do that. You're stepping up or you're stepping down in the market. And you have need, obviously, to be able to close this deal. One of the things that the IRS will tell you, and I'm telling you right now, is that if February 15th comes about and there is no deal for this wall, the president has stated that he will shut down the government again. Now, the essential services, and there's a lot of them out there, but the IRS being one that really affects us in the mortgage and in the real estate businesses. That's really important that you get the request for the 4506 or 4506T in now. I think there's still backlog from the month 40 days that they were out during the first part of the year. It's really, it's unfortunate that we all get caught up in these political issues, especially when I know you're out there and you're working 9 to 5 and you've got a great job. You're making $25 an hour. You're probably making $50,000 a year, and you finally got enough down payment so that you can get into a fixed rate 30-year mortgage. As I said, 4.5%, something you can finally afford. Yet these complete morons who run the country don't seem to understand that you count. It's not about the wall. It's about, can I buy my house and can I get my tax transcripts done so that I can get the lowest rate possible? Because without the lowest rate possible, I can't get into this house because the debt to income won't work. These are simple solutions that we need to keep the real estate market, keep this poor person who is trying to buy a house for the first time, who's in the Southern California market. And by the way, I want to say hi to KMET, KCAA, KTBD. You like that? Did we get call letters on that yet?
I have call letters. We can talk afterwards.
Excellent. Very well. Also, K Tahoe, all the great people in these particular cities that listen to the show. We're going to have a real estate agent who is going to talk about how she's solving these problems from Menifee, California. Our KMET people reach up to there. And, so Riverside, San Bernardino, Tahoe areas, hello, everybody. And certainly, hopefully, we'll have new affiliate down in New Mexico very soon. But real estate problems exist for people who can finally afford it in Southern California. That doesn't happen that often. What we have is prices that have increased, although they've slowed. Now, I've talked about this. Increasing inventory this time of year is normal, right? But what we also have is some falling demand. We do not see prices increasing the way they had been the past 4 or 5 years. This all leads me to believe that right now, for some people, it's a really good time to buy. And if you're one of these people, as I said, who are relying upon your tax returns from 2018 because, like most people, you've already filed electronically, right? Before, you get that rebate check or whatever you're trying to get, make sure that you have filed. I know a lot of people are waiting for their W-2s to be sent in the mail, and I know that they probably just got mailed out. But if you've already got yours and you've already, applied for your refund or have filed electronically, this is really important in order to get that loan. So these are some of the things that are happening this year right now, and some of the solutions that we're going to try to offer you today. Yeah, there are non-QM products. There are products out there that you don't really need your W-2. What you do need is bank statements. Now, you're going to pay more, and that's a problem for the person who has just figured out their debt-to-income ratios are going to work, but only if you can get that 30-year fixed-rate mortgage at 4.5%. And if you're out there and you don't need a 4.5%, there are some options. Now, you may have to pay 5%. You may have to pay, 5.25%. But if you are that kind of person and you got bank statement programs, and we'll talk to Heather Fox, who's going to come on from Home Express today, and she's going to give us some examples of some of the product that they have available for those people. And we always talk to those people, right? We don't often talk to the cookie cutter loan person. And why is that? Because I can't compete in rate, and Malibu Funding, who sponsors this show, can't compete in rate with someone who's an A-paper borrower with a W-2, proven income for 2 years, and be able to supply tax returns. The reason is because those large banks, Bank of America, Chase, Wells Fargo, Citi, they can offer you better rates. Because what they want to do is they want to bundle all your services together like the phone company, right? They want your checking account. They want your savings account. They want your mortgage. They want your credit cards. They want any investment in their private wealth management group. And if you have that already established with one of these companies and you've got, a 750 FICO score, well, I can't compete with the rate. That's why we don't talk about those kind of products on the show as much as I would like to. But I think if you are not that type of borrower and you're just getting into the home buying market and you're looking around to the best rate. Hey, Matt Ishiba from United Wholesale said it 2 weeks ago, and I said it last week on the show. The mortgage broker, mortgage banker solution for origination is best for many different types of borrowers. And the reason that it's good for many types of borrowers is because choice in the marketplace is always the best. And I don't care whether you're buying bread or whether you're shopping for a mortgage. You're buying a car, you got to compare shopping. You got to get out there in the marketplace. You can shop all you want online. And one of the things that, and we didn't get him on the show today, there's a tech guy I wanted to get on the show. He talked about technological solutions for the mortgage originator passed on to the customer, the consumer, the borrower, in the form of lower fees. Now, what do I mean by lower fees? Every time a loan transaction takes place, there are fees associated with that. Look at your closing statement. Look at your loan estimate. Look at your closing disclosures. All of these documents, if you have currently done a mortgage loan or you're about ready to do one, they will describe to you fees in there, which can be done away with technology. There are integrations that are currently being offered by a number of different providers. Hey, Rocket Mortgage has been trying to do this for a couple of years. Problem is that they do not have a fully integrated platform. You cannot do the loan 100% on your phone. You just can't do it. You got to talk to people. And when you talk to people, that's a salary. And that salary has to be paid by somebody. But in the independent mortgage broker world, where, as I always say, you're dealing with people, unless the loan closes, they do not get paid. They're able to help you, and if technology helps them by lowering their cost, they can easily pass that cost on to you. The credit reporting, the pulling of credit report beyond, like for instance, there's an initial credit pull and there's a credit pull when you are about to fund your loan. Also, the cost to the broker, once that loan gets sold, they're going to pull the credit again. So that's 3 credit reports that they're going to be pulled. You may not be aware of it, and you may only be paying one time, but that cost could be $60, $70 to the loan company or the loan officer has to get passed off in fees to somebody. Therefore, the rate by which you get and the fees by which are charged are considered higher. So if there's a technological solution to help you lower those costs, that gets passed on to you. That's a good thing. I'm Jeff Barton. I'm your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's a telephone number. We'll talk about loans today. I want to get right to it. News to use in this section of the show. Let's talk about what the rates are today, right now. And this is an average of rates that are across the country. And if you hear this for the show, call for a quote. But for today, it is 30-year fixed rate, 4.5%. FHA VA loans at 4.125% to 4.25%. Now that fluctuates depending on you as the borrower, depending on the program you choose, whether it's FHA, whether it's a fix-up loan, whether it's a 30-year fix, or whether it's a VA loan and the type of borrower you are. The 15-year fixed rates 4% to 4.125%. Now that's a great loan. If you want to look at a payment, and if you can afford a 15-year, I did this with my loan, okay? I was, this had to be 15, 16, 17 years ago. I've paid off my loan because I decided to go with a 15-year fixed. It was a loan, it was a $2,100 payment. I could afford it. And it was, at the time when I got the loan, 5.125%. Now, as rates sunk lower and lower and lower, I never refied. I never wanted to. What I wanted to do, because I was focused on paying off the mortgage, was to be able to concentrate on making enough money to pay that mortgage 360 times, which we did, and it was paid off last year. But this particular rate, think about this, 15 years at 4% possibly. That's pretty cheap. I mean, even if you're going to up your payment by a couple $100, this is something by which you should think about, because equity in your home is great for your retirement. If you're, let's say you're 40 years old, 45 years old, and you've got some years left on your mortgage, based on a 30-year. If you've got over 10 years, 15 years on your 30-year, well, yeah, look at the difference between the payments. If the payments are substantially the same, because a lot of people 10, 15 years ago when they got a 30-year fix, their rates were over 5.5%, 6%. So if you're looking to go 15 at 4, well, you're going to be paying actually less than you probably were currently paying. It's a great idea if looking into that product. There are some ARM products out there. What's an ARM product? And by the way, that's one of the things I can talk about right now, ARM products. What's happened with the ARMs? Remember those dreaded ARMs, those, fixed rate loans for a selected period of time, and then they adjusted the adjustable rate mortgage. That's what an ARM is, adjustable rate mortgage. What happens? You want a 5-1 ARM. People go, what the heck is a 5-1 ARM? Is a 5-year fixed loan, and after that, it's an adjustable loan. Okay, how does it adjust? And thank you, Daryl. Daryl brought me a nice glass of water. Let me take a little sip. That's radio taboo, by the way. And nobody likes to hear a swallow on the air. And that's one thing. I hate hearing people eat in movies and water being poured from a pitcher. Just a personal pet peeve. Sorry, I just had to share that with you. But if you're one of these people out there and you're thinking about what kind of rate, and maybe an ARM product is what you're looking at, the ARM product, 5-year ARM, 4.25 to 4.65%. And you're thinking, well, wait a second, that 30-year fixed isn't all that different from the 5-1 ARM. You're right, it's not. So you really have to grind your broker, go and look at this particular product. And it may be that, as I said in this article that I was reading, what's happened with the ARM products is that what we've got is a loan limit in the size of what you can do with a fixed rate loan. And the fixed rate loans, I believe, in San Bernardino, Riverside County, are different than the ARM loan. If you wanted a $675,000 ARM product, you could probably get a cheaper rate than if you went with a $675,000 30-year fixed rate loan, because the conforming rates in San Bernardino and Riverside County are less than that. So this would be considered a jumbo loan, and that particular rate would not apply, right? So you're probably going to pay another half point, maybe 5% on a jumbo loan in San Bernardino Riverside at $675,000. However, the ARM product, the loan limitations are above $675,000. So you'd be able to go and get that particular rate and be able to use that particular rate for your 5/1 ARM. So maybe that's the reason why what I've said is that the size of the average fixed rate mortgage last week nationally was $280,000. The size of the average adjustable rate mortgage was $688,000. Okay, that's why. Because at $688,000, you're above the conforming limits for a fixed rate mortgage. So you're not going to get a rate of 4.5%, 4.25%. No, you're going to get more, like I said, a 5% loan, because that's what it's going to cost you, maybe even higher. So if you're looking for a product that you can get a great introductory rate that you know you're only going to stay in for 3 to 5 years, this ARM product is terrific. The 5/1 ARM is in a great rate for you, and you'll be able to obviously try to refinance. However, we get into the dreaded what happened in 2008 syndrome, right? Everybody, well, most everybody, and by the way, since 2008, and that was, how many years ago was that, Darryl? 9, 10, 11?
Yeah, 11 years.
Okay, so 11 years ago, there are how many new borrowers that don't remember those days of why it was a bad economy? Kids who were 18 years old then are now 30 years old. There's certainly millennials buying houses right now. And there's millions upon millions of these borrowers who don't quite remember what happened back in 2008, right?
Well, first of all, the millennials just started to buy houses. You know, they were pretty transient group because they didn't keep jobs for too long and they moved around a lot, but now they're starting to settle in.
I agree with that, although I disagree only that millennials have been and did become a couple of years ago the largest mortgage holders in the U.S. Now, it's the largest group in the U.S. I mean, there's probably some 60 million millennials out there in a country of 350 million where only you have 150 million of those people working. So 60 million is probably 33% of the working population. And all of these people, there's probably 50% of those millennials who own houses. But there's a huge number that don't own houses that we're looking to get into the marketplace. But the millennials themselves, the people that we're talking about in terms of trying to get a mortgage, trying to decide whether they're going to use an ARM product, not use an ARM product, don't remember 2008. They don't remember that the reason that the country got into trouble with mortgages was because people were borrowing on time. There's no way they were going to be able to refinance a property out of whatever the rate was at that particular time and continue to do that, as was happening. Every 6 months you'd refi, take $10,000, $20,000 out of your house, and the house kept going up. Well, there's a difference between what was happening then and what's happening today. What's happening today is that there aren't those artificially inflated numbers when it comes to housing values. There aren't the flipping of properties by people who couldn't afford it. There's the ability to repay rule, which is incredibly important to each and every loan and to each and every loan company. It's not just about the borrower. It's when that loan is made, what happens to that loan? I got to sell that to somebody. Those people have strict regulations on what I'm giving them. I have strict regulations on me about how to try to make that loan to you, the borrower. So there's a lot more in place today than there was then. But the ARM rate had such a bad rap in those days that people are still afraid about it. However, if you're a person who is aware of what the adjustable rate mortgage is, and obviously if you're going to sell the house before 5 years, it's no problem. But You got to work this out with your mortgage broker, your mortgage lender, or the bank to make sure that you fully understand the ramifications of an adjustable rate mortgage. And there are tables that'll show you what the adjustable rate has been over the last 20, 30 years so that you can have somewhat comfort. But you just want to make sure that if you're an adjustable rate, you're not thinking about what it was in 2008 in a bad way, but you're thinking about what could happen if. And that's a way by which you can protect yourself in the ARM product. I think they're great products. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone, give us a call. We talk about mortgages. We talk real estate. We talk what's happening in the market. We talk national issues that affect real estate decisions. And I don't know if, Daryl, did you see that GM just hired 1,000 people locally?
I did.
Yeah, it's pretty good. And so if you're out there and you're working right now, things are pretty good. If you're not working, I think there are jobs available for you out there. We certainly want you in the mortgage market, and we certainly want you in the real estate market. There are some great opportunities in places where this show services, and one of the areas is up in the Temecula area. I want to bring to the show a first-time person who is graciously accepted to be on the show today for an interview, and her name is Tracy Madden, and you can go to tracymaddenhomes.com, her website. Tracy, how are you?
I'm doing well. How are you doing, Jeff?
I'm okay. I was actually kind of nervous right there because, anytime I really don't know somebody, I get nervous. So calm me down and tell me a little bit about what you do up there in Temecula and how your business is.
All right. Well, business is great. So the nice thing about Temecula is that we're kind of smack dab in the middle of LA and San Diego. And home prices are a little bit lower here, but you still have great accessibility to either major city. So I've been seeing a lot of people coming from LA and San Diego and making the commute out to the city. So business is really good. I'm working with EXP Realty, and
okay.
we're based out of Temecula, out of the Real Estate Resource Center. So a lot of really cool things happening there.
Okay, let me ask you a couple of questions about the market because you brought it up and you say that people are commuting. Give me some idea of what the prices are. Give me a median price, maybe a high-end price, something that I don't know, which is a lot about what's going on there.
All right. Well, so out here you can get a lot more house for your dollar.
Okay.
So we're talking prices. If you're in the Menifee area, you're going to be looking in the high threes. And even though I work out of Temecula, I actually live in Menifee.
I see.
I love it here. Some people would even call it rural.
Okay.
It's growing a lot, though. But you're looking at homes, your standard, like 4-bed, 2+ bath, high threes, easy, with, a good 7,500 square foot lot. If you go into the Temecula area, it's a little bit higher price, but you're still looking in the fives.
Now, how much product do you think you have out there? Do you have a 3-month supply, a 5-month supply? Because anything closer to the big cities, of course, there's been such a crunch on housing. How is it out there?
So we've got a lot going on right now. In Temecula, in the last 6 months, we've sold 700 homes.
Wow, that's a lot.
Yeah. So there's a lot on the market. I've been seeing a slight shift in, home prices have dropped just a slight bit out here. So I think we're seeing a little bit of a normalization of the market, or a correction, what have you. But yeah, there's a lot of homes on the market, and there's a lot of buyers looking to grab those homes.
When you represent a buyer or a seller, what are some of the issues that come up there that may interest our listeners? I know that in each city there are specifics. I know whether it's in LA, whether you've got sewer connection issues, or whether you're in high fire zone areas, you've got fire insurance issues. Give us some of the issues that you may encounter there with a buyer or seller.
I don't run into a ton of issues out here. I mean, a lot of our homes are newer built. you do have the fire areas.
Right.
That is an issue that cropped up this past October.
Right.
I don't know if you're familiar with Lake Elsinore, but
Of course.
that is in part of our area, and the big holy fire that happened, that hit really close to home for us.
Right.
And with all of the recent rains that have been happening, those same people that had to deal with the fires burning right up to their backyards are now dealing with flooding.
Yep.
So that's probably the biggest issue I've been seeing out here.
And buyers in your car, or do you drive around? I don't know how they show properties in your area. In my area, I don't put anybody in my car if I'm showing a house. I just don't like to, never did. But in your area, you're driving around, the conversation turns to what are some of the hot button issues? The schools, the cost of living, jobs. What are people talking about?
People are talking about the schools, and
Right.
that would be because Temecula and Murrieta have some of the best award-winning schools in California.
Great.
So I've been seeing a lot of people that particularly want to be in Temecula for the schools. If you have a special needs child, they have really great programs. It's just a really great area, and it's not as impacted as you see in the cities.
Right. We had that big teachers' strike. I guess they solved that in about a week. Any issues with striking teachers or garbage workers or, municipal workers? I know that it always disrupts, especially when we have, need, whether it's fire season or flood season, anything like that on the horizon in your area?
I don't think so.
Mm-hmm.
We didn't have any teachers striking, and to my knowledge, I haven't seen a disruption in any of my services.
Good.
I believe that we are trying to grow our, fire and police forces out here. There's been a lot of debate about that, but I think that we're seeing so much growth, both with inventory of homes. There's a lot of new homes being built.
Right.
There's a lot of opportunity out here that wasn't here 20 years ago.
Oh, that's excellent. So you have a lot of house building. Who's out there? KB, Pulte, Shea? Who are some of the big builders that are out there?
Party, D.R. Horton,
Right.
everything you just named. We're seeing a lot of new builds going up. Just in Menifee alone, we've got 10.
Wow.
More.
Wow, that's a
Yeah.
lot. No, I've seen some of the plans out there. They're planning for thousands of homes in that area, right?
They are.
Right.
So, because you know how I mentioned that it's still kind of rural out here?
Yep.
There's a lot of open land to be built on. And for about 5 years, nothing was really happening. You saw some half-finished projects.
Right.
Nothing was going on. And in the last year, it's just blown up, and they've been throwing up houses left and right. The prices are still really great. You can get a brand-new home for between $400,000 and $600,000. And I'm talking a standard-built family
Right.
home.
It's funny. We talk about these prices as if they're small. I have friends back in the Midwest and certainly in the East, and they always blanch every time I say, "Oh, that house is cheap." It was, $600,000-700,000. Like $600,000-700,000, but that is the way it is. Even in Temecula, Menifee, the areas which would be considered inland from, let's say, coastal areas, San Diego and Los Angeles, right?
Correct.
Right. So where do you see the prices headed?
So I've seen a slight cooling in the market as far
Okay.
as prices go. I've been getting a lot of reverse prospecting saying, hey, we dropped the price on this house.
I see.
However, areas such as Paris and Hemet, where you've traditionally seen the less expensive houses,
Right.
they're seeing growth of 6 and 11%
Wow.
increase.
Wow,
in price.
that's big. That's this year, 2018 it was?
Yes, correct. And in Temecula and Murrieta, where prices have been typically higher,
Mm-hmm.
we've seen a decrease of about 5%. And Menifee has stayed about the same. So you haven't seen an increase or a decrease in prices.
Okay, we have about a minute and a half left. You want to shout out your phone number for people so that if they wanted to get in touch with a great agent out in your area, they can?
Yes, please. My name is Tracy Madden. You can find me on Facebook, Instagram, TracyMaddenHomes.com. My phone number is 951-609-4077.
Okay,
I'd
so
love to hear from you. If you have any questions, please don't hesitate to reach out.
great. I got about a minute left. Tell me, What do you like about real estate? Give us your best pitch as to why you chose that particular profession.
I actually went into this profession because a few years ago I was approaching my 30s and I had never owned a home. So I wanted to know what I was doing wrong and how I could educate myself. And it turned out to be a great career path for me. My passion is helping people understand real estate, making it fun. You know, this is one of the biggest financial investments that you're going to make. I want to make it fun, but I'm going to represent you. I'm going to take care of you.
Great.
So,
hey, thanks very much for coming on the show. I want to do it again. I want to make you our Menifee reporter. There's a high demand for that job, so I really appreciate it if you come back on the show.
Absolutely. I'd love to.
Thanks, Tracy. Thanks very much. And that's been Tracy Madden, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone, give us a call. You know, you can email us too, info@malibufunding.net. I'm Jeff Barton, by the way, and I've got a YouTube channel that you can see this show, our Las Vegas real estate show, and hundreds of other things that are on that particular channel. If you go to YouTube, just type in my name, Jeff Barton, the real estate voice, and you can see, you know, the hundreds of shows. This particular show will be up on Saturday, and anybody that you see and hear on the show, they've got their name, their phone number. You certainly can get in touch with them, as what we want to do is try to inform and bring to you great guests that you can see and hear over and over again. We get, I don't know, about 40,000 downloads last year of the show. So I know people are watching us online and downloading the podcast version of the show. Today is no exception with great guests from Home Express we bring to the show. Once again, Heather Fox. And Heather, how are you?
I'm doing great. Thanks for having me on the show, Jeff.
Okay, and thank you for coming on. I know some people like doing it. Some people think it's like going to the dentist, but it always informs the audience because they're the ones that really need help. Most of them don't have a clue as to what's going on out there.
Sure. Well, Home Express, we're a lender that specializes in loans that help borrowers with credit events. Credit events may be a bankruptcy, like a Chapter 13 or 7. Maybe you short-saled your home, a deed in lieu, foreclosure, anything like that. We have certain programs that can help those types of borrowers. One of our biggest programs is directed more towards the self-employed borrower.
Okay.
Maybe one that just doesn't have, they have maybe too many write-offs or whatnot, and they just need to do bank statements. So we are now qualifying business borrowers on our bank statement program, which has been amazing. We call our industry a non-QM industry.
Of course.
And it's supposed to, I would say, quadruple over the next year.
Yeah, no, I've heard that too. I heard the business, and the reason is, I guess, is because the rates are going up, right? And so the pool of borrowers has been expanded because the programs are more than they were 4 or 5 years ago.
You're absolutely correct, and we're just getting some more. The hedge funds are opening up a little bit more. We're just getting more movement in this side of the business, and just more interest all around.
Hey, is there any worry? I apologize for interrupting, but it brought to mind a question about what is Home Express's view on what the economy is going to do? Because everybody's worried about this pending recession. I know I've talked about it on the show, whether it ends at the end of this year or beginning of next year. People are talking about it. So when that happens, they begin to reflect on 2008, 2009, what happened then, and the loans that were, at the heart of whatever the problem was in those days. Is there any feeling or idea from Home Express as to how the economy is going to respond in the next 18 months?
Well, I mean, I don't, Home Express, I can't really talk for everyone, but I don't really think that we're going into a recession. as far as, these types of loans and being, in connection with, going into a recession in 2008 and whatnot, I can tell you that, non-QM is not like subprime.
Okay, good.
Non-QM, we're regulated by the CFPB. There's a lot more that's put in place. I mean, back in 2008, lots of things were going on. Appraisers, there were no AMC companies.
Right.
There were just several different things. This is a very stable product.
Right. I agree with you, by the way.
For the true
Right.
self-employed borrower. There's no pick-a-pays and all of these different prepays on a 1-year fix. None of this is going on. These are very stable loans. So
Right.
I think that we're going to do great in the years to come, and I personally don't think that we're going into a recession now. That's my view, though.
Okay, no, I appreciate that. I think the loans, non-QM loans, are great loans, and I think it has very little to do. But I often hear from borrowers, from people who aren't necessarily in the mortgage market right now for a loan, they're always worried, especially when they hear on the radio or on TV or however they get their information, that new programs, new loans are available, and they just feel the word pick-a-pay. I mean, I haven't heard that in probably 7 or 8 years, but you're right. There aren't pick-a-pay type programs out there. There's nothing that's going to scare off or make the loan worse because it happens to be a non-QM loan. There's still the ability to repay. There's still equity in the home. I think a lot of these programs that you're offering really speak to the need rather than trying to make up a need by having some, hybrid fancy program.
No, you're absolutely right. I mean, again, there also is, for lack of better words, some skin in the game. We're not
Right.
doing these 80-20 purchases anymore. And,
Right.
With these inflated values from these appraisers that aren't monitored. Everything is regulated, like I said, down to the AMC, down to, how we do the loans, the CFPB, how we even board a loan. It's completely different. It's
Yep.
a full haul from what it was, back prior to 2008.
Hey, tell me what your typical borrower is for one of these loans in the non-QM space. What do they look like? Are they just business people? Or are they all walks of life? Give me an idea of a profile of one of your borrowers.
Definitely all walks of life, but a profile of my borrower. Maybe a borrower that had a bankruptcy 13, right?
Okay. Yep.
They're just looking to reestablish and maybe pay off that BK, pay off their debts, get their FICO score up, and just kind of do a reorganizing of their life and their whole financial picture. We have these programs out there to help these borrowers, and there's a huge need on it for these borrowers. You can't get a Fannie Freddie type loan with someone in a BK unless it's maybe 7 years out, right?
Right. That's right.
A borrower like that would be a perfect borrower to come to us, so that we can help them kind of just restructure, so that they can put themselves in a better position to, one day, maybe in a year or two, get a Fannie Freddie loan, right?
Right.
With a better rate. Not to say that in 1 or 2 years that our rates won't be right about where their rates are.
Right. No, you're right. They're going to be raising. Right.
Right now.
Mm-hmm.
But yeah, that self-employed borrowers, I have a loan right now going on. Quickly, I'll tell you.
Yeah, please.
Long story short, just owns a car wash,
Right.
and he puts money from his car wash into his personal account to pay his bills. We're asking just for 12 months bank statements. We don't even need an expense factor because it's going into his own personal account. He doesn't have to deal with all of the extra paperwork that goes along with, qualifying a self-employed borrower, things like that. We don't have any MI. So for people who, are looking to purchase a home and it's at 90%, we're not going to put MI on them, which is good, especially those people who are doing like FHA loans, and they can bring in maybe 5% or even get a gift.
Right.
Of that 2% versus a 3.5% down, and not have mortgage insurance. These are great options for those people as well.
Okay. Hey, listen, could you shout out your phone number? We got about a minute left, and I want to make sure people can get a hold of you.
Absolutely.
If they want to, this is Heather Fox from Home Express, and her phone number is?
714-270-4883.
Okay, excellent. Okay, you talked rates here a little bit. You said that they're a little bit higher than, I would say, Fannie Mae or Freddie Mac 30-year fixed loans. Give us a range of prices depending on, especially talking about the type of borrowers you've been talking about.
Well, I can tell you, I mean, our lowest rate you're going to see right now is about 4.625.
Oh, that's good.
My average rate is going to be about 6.5.
Right. And those are the type, right.
It can get up to, 8%. I mean, in the higher LTVs, lower FICO scores.
Hey, you know what? I got to go. This went by really quickly, and I really appreciate you once again coming on the show, telling people what great products you have over at Home Express.
All right, you take care. Thanks for having me on.
And thank you very much for coming on. That's Heather Fox from Home Express, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone. Give us a call. We want to talk to you about your mortgage. We want to talk to you if you have a solution already. Hey, look, you don't have to call us, right? It's fine if you want to go to one of the large banks on the corner and get lousy service and wait in lines and have a 30-day escrow, wait another 30 days because you can't get answers because the person went on vacation or they're on maternity leave or, they just quit. Or look, you want to go to somebody who is going to give you the most service and be on top of your loan 100% of the time. You probably want to choose somebody like Malibu Funding or any number of other companies out there who are brokers or mortgage bankers. Service is the only way we can compete. And why do I say that? Because if we don't close your loan, we don't eat. Bank of America, hey, those people are salaried people. Yeah, they may be on a quota, but you know how those large companies are. Anyway, enough of that. If you want to give us a call, 888-713-2929 is the telephone number. If you want to email us, info@malibufunding.net. We're on YouTube. My Twitter handle is @Jeff6493. Some of the things that I've been talking about on the show today, the rates, what they are now, how they are affecting you based on what you can afford. I read an article today about the historical analysis of interest rates in the U.S. and some about the history of mortgages. Most people don't realize that before World War II, and for those of you who don't remember World War II, that was that big thing that happened in the 40s, the late 30s, 1940s. Yep, it was called World War II. Well, before then, there were no mortgages. You paid cash or you rented. Either you bought something 100% or you rented. The notion of government-backed financing never really took hold in this country until after World War II. And the reason for that, historically, there was just no market. There was no financial instruments that were created in order to make money by lending money. That was the notion of credit did not exist prior to World War II. Yes, your local grocer would give you credit. Yes, your local person that would give you feed for your animals or seed for your farm, because before World War II, you probably have 70% of the country still living in the rural areas of the country and also farming. Well, you don't have that. And since World War II, when we've developed a mortgage market, a way to get a mortgage, both locally and nationally, and to be able to have mortgage instruments that are bought and sold. I mean, it is so sophisticated now, it would spin the head of anybody prior to World War II to see what we're doing now with mortgages and how people get to borrow hundreds and thousands of dollars based on really a promise. And the promise is, I will continue to pay. And that's really all it is. I mean, all the paperwork aside, when we talk about the ability to repay, and we talk about, as Heather was talking about, or it was Tracy, either one of them talking about the appraisable management companies. What's an appraisal? Somebody comes out to the house, tells you what it's valued. But the arm's length distance that it has from companies trying to buy and sell your mortgages, people who are borrowing money from one company, lending it out to you in a different way. All the paperwork, all the things that are invested in trying to get you, these things never existed. People would be shocked as to how it works. And it's come about quickly. Since 2008, we have a lot of, I guess, rules in place. Yeah, let's call them rules. A lot of things that prevent the type of problems that we had in 2008 where they were giving money away. We had this World War II to 2008, and because of the numerous things that were happening in the country, whether it be the mortgage meltdown, whether it be the wars that were off-book funded by the Bush administration, whether it be, the internet bubble, there were all kinds of reasons why money was pumped into the system. And it was pumped into the system through the mortgage market, right? By making money available and free that you could get a signature loan. You could buy 7 or 8 properties based on inflated appraisals. That doesn't happen anymore. But the fact is, from World War II to then, the market had morphed into this thing that was making the economy robust. It's not like that now, but the mortgage market and getting a mortgage is unbelievable, and the ability to be able to do so is still unbelievable. So let's talk historically. Daryl, let me ask you a question.
Yes, sir.
Okay. Now let's go back to 1980s. Jimmy Carter was president, right? After Nixon. Mm-hmm. What do you think in 1981 the average interest rate on a 30-year fixed loan was? Take a guess.
20%.
17%, according to this article. 17%.
People today would they dry it in the streets.
They not only that, you just wouldn't be able to do that kind of financing.
No.
Even then, the financing available at 17%, the mortgages compared to what we're doing today at almost $1.8 trillion in mortgages will be done this year, albeit at 4 to 5%. Not 17%, but there was a lot of seller financing. So let's drift ahead 10 years. 1990, what do you think the rate was? Exactly. I don't remember either. I had to look at this paper.
13, 14.
It was 10 point, let's say 10%.
Yeah, go in the right direction.
10%, that's correct. But 10% in 1990, 1990 wasn't all that long ago, although, I guess we're looking at 40 years.
Well, I bought in 99, so I know where we're going.
Okay, let's go to 2000. What was the rate?
I got 5.75% in 1999.
You're kidding me. Yeah. Nationally, 8.25%. Well, you were rolling in it then. Great credit, lots of money down.
Yeah.
So high-end borrowers probably got better rates in those days. And did you get it from, what, we had a blackout? Yeah, something happened.
It got all dim all of a sudden, and it's not me or you.
That's very funny. I don't know if people who are watching this on TV can see that we just had like a New York blackout here. Anyway, so let's come to 2005. We'll slow it down every 5 years. What do you think the interest rate was in 2005?
Oh, boy. 2005, it was probably back up a little bit, probably 8.
No, it was about, here it says it's almost 6%.
So it was still down from their 8.
Correct.
Yeah.
Correct. 2010? Now this is after 2008.
Yeah, I understand. So it's still going lower probably.
Yes.
4.
This is 5%. 2015 was at its low point.
Okay.
And that was about, what do you think?
Well, you're at prime or below, so you're probably 3.5%.
About 3.5%, that's correct. And now today, what do we have? 4.5%, right?
Yeah, 4.5%.
4.5%.
Yeah.
So historically, we are in a period since 2010, really, that can you imagine back in, pre-World War II days to say to somebody who's looking to, in those days, houses were $5,000, but still out of the reach of most people. But imagine offering it to somebody to say, hey, I'll lend you all the money for that house, and you pay me, what's 10% of 5,000 simple is $500 a year. Half of that is $250, right? Think about this as a monthly payment, not $250, it's 12 into $250.
Yeah.
So you're paying, I don't know, $25 a month for your mortgage.
Well, my parents bought a house the year I was born, with 1956,
Okay.
and I think that the house was $18,500.
Right.
I think their house payment was $87 a month.
It's unbelievable.
Yeah.
But in those days, renters, everybody rented.
Yeah.
They were unless you had a family farm that was passed down generation to generation, you were renting, especially if you were moving to the city. If you were coming home from World War II, you rented, although that's when the mortgage market got started. But rates in those days were high, too.
Well, I mean, every comedy show, the brunt of the jokes was the landlord.
Right, exactly. The landlord banging on the door.
Yeah, landlord.
And I know it's really amazing. So if you're out there and you're complaining about your rate today, and you're complaining that you can't afford a loan today, just give it some historical analysis and thank God you're living today. Because without interest rates what they are, we would probably have very, very few people that could afford a rate. 4.5%, 5.5%, in that range, historically low. And I believe we're probably going to see these rates stay this way for a while. I don't think we're going to see over 6%. Anyway, thanks for jumping in, Daryl.
Pleasure.
I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.